Made it to chapter 12, which is the final chapter in the Principles of Accounting 1 course. And this chapter actually kind of neatly wraps everything up by taking a look at financial statements analysis, or analyzing the financial statements that we have been learning how to prepare throughout the course of this semester, ending with chapter 11 and finally getting to that cash flow statement. What we want to do now is take a look at some of the tools that investors and other analysts will use to determine how well run the companies are who are releasing these financial statements. And so we're going to take a look at really a recap of all of the financial ratios that you have already seen, starting, I think it was beginning at chapter 4 with cash. The last part of every chapter had us working on different ratios. If you have been faithful in taking a look at those, learning what they are, this will probably be the easiest chapter that you've had in the book so far. So we're going to take a look at revisiting all of those ratios, and we're going to add two tools to this as well. One is called vertical analysis. The other is called horizontal analysis. And you'll see the obvious reasons why we call them that. As I often say in accounting, we call it like we see it. But these are tools that will allow us to, in some cases, compare what we have done for the current period to some points in the past for our own history. And you find other cases where we can use the results of these analyses to compare ourselves with other players in our industry. So we want to take a look first at this question 1 that deals with vertical analysis. And we have some information here on a company called Sports Unlimited. We have their 2021 and 2020 and 2021 balance sheets. They want us to, in this first problem, to express each amount as a percentage of total assets for the year. So we're looking at the balance sheet and wanting to do a vertical analysis. Why do we call it vertical? Because we're going up and down as we do these calculations. Where the balance sheet is concerned, we are going to look at total assets as our base point. We're going to simply divide every single item on this balance sheet by total assets. So where cash is concerned, 103,500 divided by 450,000 gives us 23. So we're saying that cash is 23% of our total assets. Accounts receivable, 46,800 divided by 450,000. And we have 10.4% of our total assets, our accounts receivable. Inventory, we do the same calculation. We should come up with 9.9. Prepaid rent, we should show 1.6. The investment in bonds, 54,900 divided by the 450,000 gives us 12.2%. Land represents 26.1% if we do the math right there. 106,200 divided by 450,000, we're looking at 23.6%. And accumulated depreciation, because this is negative, we also want to make the percentage negative. Total assets, obviously, is going to be 100%. So you may ask the question, why would we divide all of these liabilities and stockholders' equity by total assets? Well, we could also say total assets or total liabilities plus stockholders' equity, because remember, those two have to be the same number. But it's just easier to say for the balance sheet vertical analysis, divide everything by total assets. Because what we're really saying here is accounts payable, this 30,150, which, yeah, it is actually 30,150. Divide that by 450,000, and we come up with 6.7%. So we could say that accounts payable is 6.7% of our total assets, or we could say that accounts payable is 6.7% of our total liabilities and stockholders' equity. And that probably makes more sense for us. 7,200 for interest payable equates to 1.6. Income tax payable is roughly 2.7. Notes payable, this 138,150, is 30.7% of our total liabilities and stockholders' equity. Then we move to common stock. This represents 32%, and our retained earnings represents 26.3%, giving us a 100% here where total liabilities and stockholders' equity is concerned. Now, we can do the same thing for 2020. For 2020, we want to make sure that we use the 400,000 mark here. So $70,400 divided by 400,000, 17.6. 8% for receivables, 17.8 for inventory, and prepaid rent is 0.9%. Oops, I think I laid on that one a little too hard. Our investment in bonds, we didn't have any in the first period there, so that's nothing. Then we have land, which is 35.4. 102,000 is 25.5%. And then we have a negative 5.2 for accumulated depreciation, giving us again 100%. Oops. So the total asset lines and the total liabilities plus stockholders' equity lines are always going to be 100% in the case of vertical analysis. Accounts payable here, we should come up with 11.7. We have 0.9. 10,000 divided by 400 is 2.5. We have 31.9 for notes payable, 36% for common stock, and 17% for retained earnings. Now, one of the things you can do here is take a look at how these amounts changed from one year to the next. So obviously, the company has a higher percentage of cash. They have a higher percentage of receivables as well. Their inventory is less, which means that they have been selling off their inventory. This could be a really good thing for us because inventory is what we want to sell. And then you can go down, look at the long-term assets. Likewise, taking a look at the liabilities, our accounts payable is about 5 percentage points less, which means we have less debt on our books from a current liability standpoint. When we look at notes payable, that has gone down. And then our common stock and retained earnings, the common stock went down, but our retained earnings have increased significantly, which means that we are growing the business here. So that's it for the vertical analysis. Again, up and down. We want to use total assets as our base when we're dealing with the balance sheet. If you were doing vertical analysis on the income statement, then sales is your base. Everything gets divided by sales. Every single item on the income statement gets divided by sales. Here's where students sometimes make the mistake is thinking, they forget that, do I take the bottom line as the denominator there, or sales actually is the first line on the income statement. Sales, top of the line where we're talking income statement. When we're on the balance sheet, though, it's the bottom line. It's the total assets or total liabilities plus stockholders' equity. Let's move on to question 2. Okay, for this one, we are looking at the horizontal analysis. Vertical went up and down. Horizontal, you guessed it, is going to go side to side. So we're dealing with the same information, same 2 years given to us here. What we have to do in this case is take the difference between these two numbers, put that amount here. So from 70,400 to 103,500, there was an increase of $33,100. Now we want to take the $33,100 divided by the base year. The base year is always the earlier year unless they tell you otherwise. So always assume the earliest year unless you are told otherwise that something else is being used as the base. So 33,100 divided by 70,400 gives us 47. What this is really saying is that there was a 47% increase in cash going from 2020 to 2021. Doing the same thing for receivables, there's a difference here of 14,800. That difference is positive. That 14,800 divided by 32,000, our base year, gives us 46.3% increase in accounts receivable. Inventory went down significantly. That's a minus 26,650. The minus 26,650 divided by 71,200 would give you a minus 37.4. So there was a 37.4% reduction in our inventory from 2020 to 2021. There's an increase in prepaid rent of 3,600. That is actually doubled or 100%. Doing the same thing for the long-term assets. We're literally doing this exact same thing for every item that we see here. And that percentage there, we can't do it because we can't divide by 0, so just leave that one blank there. The difference between the land, there was a decrease of 24,150. That is actually, if we do the math, minus 17.1%. 24,150 divided by 141,600. For equipment, we're looking at a land went down. Equipment is going to increase by 4,200. That is 4.1%. We have minus 9,800 as the decrease in accumulated depreciation. It's technically, that represents 47.1. The total assets increased by $50,000, and that is 12.5%. Okay, our accounts payable, we're going to do the same thing. We decreased our accounts payable debt by 16,650. 16,650 divided by 46.8 gives us a decrease of 35.6%. Interest payable, we are looking at an increase of 3,600. That doubled, 100%. Income tax payable, 2,150 increase in that, and that is 21.5%. Notes payable increased by 10,550, which is an 8.3% increase from 10,550. Nope, I'm on the wrong line here. There we go. Now, our common stock, there was no change. Our retained earnings, there was a $50,350 increase, which represents a 74% increase there. When we look at the total liabilities and stockholders' equity, $50,000 is our increase, and that again represents 12.5%. And obviously, because total liabilities has to equal total liabilities plus stockholders' equity have to equal total assets, those two lines should be the same. That is the horizontal analysis method there. And again, we are going horizontally, and this is why we call it horizontal analysis. Question 3. This question has us, as well as chapter 4, we're going to continue this with, question 4. We will continue this same problem. 3 and 4 deal with the same company, virtual gaming systems. And we're just going to take a look at all the different ratios that we have available to help us analyze how the company is performing. The first question here, question 3, asks us to calculate what we call risk ratios, and they really give us an indication of how risky the company is. How much risk have they taken on? The receivables turnover ratio would always be measured in times. Anytime you see a ratio that has the term turnover in it, the correct attachment to it as far as describing what you're doing here is times. So what I'm saying here is that I am turning over my accounts receivable this many times, meaning that I'm collecting them this many times a year, completely collecting the total balance this many times a year. In order to calculate this, you would go back to that receivables chapter. I think it might have been chapter 5, where we dealt with sales and accounts receivable. But again, all of these ratios are listed, and there's a neat little chart in your textbook as well that gives you all the ratios, I think, in 2 different sections there in the book. But the turnover ratio, for this one, if we do the math here, we are looking at, let's see, where's our big number? Where is our... Okay, here we go. I'm missing the number. My net sales number here didn't scroll down far enough. Scroll up far enough. Net sales here, we're going to take net sales and we're going to divide it by the average receivables. So the 3,086,086 divided by our average receivables. I'm going to add these two together, divide by 2. That's my denominator. So in that case, I should end up with 38.3 times. So 38.3 times a year, I am collecting my receivables. That's almost 1.5 times a month. I'm collecting my receivables. That's pretty high number there. So it should also be a reflection of what the credit policies are that the company has. Do I offer these discount terms where, 210 net 30, that would tend to bring in more of our receivables quicker, which would impact this turnover ratio. The average collection period, I'm going to take 365 and divide it by 38.3. This gives me 9.5 days. So roughly 9.5 days is all that a typical receivable is out, which almost sounds like a policy where I'm offering a discount if customers pay me within 10 days. So the inventory turnover ratio. Okay, I'm going to take my cost of goods sold. That's the number I want to look for there. And I am going to divide that by, where did we go here? The average inventory. So I'm going to take these two numbers, divide them by 2. Let's actually do that. 115 plus 145 is 260 divided by 2. So that's an average of $130,000. So I'm going to take the cost of goods sold of $1,960,000 and divide that by the $130,000 in average inventory there. And I come up with, in that case, 15.1 times. So I am selling out of my inventory 15 times a year. Depending on the industry, that sounds like a pretty good number. But again, it depends on the industry. You can only compare companies within the same industry or the same basic structure, same category in industry. So if you're in a high luxury and high-priced type inventory industry there, then the numbers are going to be different than they would be, for example, if you're dealing with an industry where you have very, very inexpensive products. So the average days in inventory, we're again going to take 365 divided by the turnover ratio, and that gives us 24.2. The current ratio, if you recall, is simply our current assets divided by current liabilities. So we are going to take, again, you have to go look for the current assets, and lo and behold, they do not give us a total for it. But if we add the current assets together, we would end up with $415,000. We want to divide that by the current liabilities, 96,104. So 415,000 is the total here, divided by 104. This gives us a current ratio of 4.0 to 1. In other words, I have 4 times as many current assets as I do current liabilities. That kind of indicates that I'm in a good cash flow position, because remember, current assets, I want to turn to cash within the next year. I can do that 4 times for every current liability I have, which almost says that I'm in a position to pay my current liabilities 4 times, 4 times over for the year. So sounds like that's a really good number. The asset test, we're going to only include the cash and the accounts receivable for our numerator, and then we still want to take all the current assets as our denominator. So this asset test, or quick ratio as it sometimes is called, is a little more fine-tuned, and it says how much cash can I turn quickly. How many assets do I have to turn into cash quickly, typically within a 3-month period, if I needed to pay off all of my current liabilities within this very, very short window. So in that case, we're looking at 2.8. The debt to equity ratio, we are looking for, where did it go here? We want to take our, where's our debt? Okay, we want to add together all of our debt, and then we're going to divide that by all of the equity in the company. So all of this debt divided by all the equity, you should come up with $399,000 in debt divided by $547,000 in equity. That gives us 72.9%. Oops, got an extra dot in there again. Okay, 72.9% is saying that our debt is about 73% of what our total equity is. So we still have more equity. What you really don't want is that number to be over 100%, because that means that you have more debt in the company than you do have equity. And I mean, I guess if you're a new business startup, that may not always be a bad situation, but you definitely want to keep that debt number down. The times interest earned ratio, if you remember that, that's the one where we're trying to determine how many times I can actually pay the interest. And it's an indication as to whether or not you can actually afford the debt that you have taken out. So you want to be able to at least pay that debt the interest on that debt a few times. What we're going to do here is go back up to the top, take our net income, and we want to add back in our interest payment here as well as our income tax expense. So net income plus the interest expense and income tax expense that we subtracted out already, add those things back in there. And then we're going to divide that by the interest expense. And I'm just, again, trying to figure out, with what I'm making in this company, can I afford the interest payments that I have on the debt that I have outstanding? And in this case, it shows that we can pay the interest almost 11 times over. So it's a good sign that you can afford the debt that you have. That's it for the first set of ratios. Let's go to the second set. Those were the risk ratios. Now we want to take a look at what we call profitability ratios. How profitable is this company? Looking at our gross profit ratio, our return on assets, our profit margin, our asset turnover, our return on equity, and then this new one called the PE, or price earnings ratio. Although, well, we actually did the price earnings ratio before. Okay, our gross profit ratio. If we look at our income statement, we want to take our gross profit and simply divide it by sales. So 1,126,000 divided by 3,086,000 gives us 36.5% gross profit. What does that mean to us? I have 36.5% of every sales dollar available to run the company. That's not really the greatest gross profit percentage, because what it's saying is that your cost of goods sold is what? About 63.5% of your total sales price. And that's a lot. Not a lot of margin there to work with. The return on assets, we are going to take our net income and we want to divide that by our average assets. So we're going to take the 794,200 plus 946,000 divided by 2. And we're going to take 139,000 divided by that average. That gives us 16%. The profit margin, I am taking the 139 and dividing it by 3,086,000. That gives me 4.5%, which basically says out of every dollar in sales money that I receive from my customer, my net income, I get to keep 4.5 pennies. So 4.5 cents on every dollar stays in the company as a part of net income. The asset turnover ratio, seems like we just did this in the previous chapter maybe, but the asset turnover ratio, we're going to look at our net sales and divide it by the total, the average total assets. If I can move this here. And that's going to be the 946,000 plus 794,200. Add those together, divide them by 2. Whatever that answer is, you are going to divide into 3,086,000. So 3,086,000 divided by the average of these two numbers here. This gives us 3.5 times. I'm turning over all my assets. 3.5 times a year, I turn my assets into, I completely, basically, I'm turning those assets into sales 3.5 times a year. Return on the equity, I am going to take the 139,000 net income, and I want to now take a look at my equity in the company, which is the 547. Where'd you go? Oh, here we go. We want to take the 547 here plus the 449 here, 449,200. We're going to add this together plus this and divide by 2 to get the average amount of equity that we have in the company. Okay, we're going to take the net income and divide it by that average equity. That gives us 27.9%. And then finally, we have this thing called the PE ratio. And this is where we're going to take, we have to look at this information that's given to us here. And they actually give us the numbers in this case. We're going to take the closing stock price for whatever day we're trying to determine this for. And typically this would be for the end of the fiscal year, at least for the end of the fiscal year, but you can do it anytime throughout the year. And we're going to say $28.30. $28.30 was the closing stock price. We actually divide that by the earnings per share. And that gives us 20.2. And the general rule, again, I think we talked about this in the stock chapter, but the general rule here is that a high PE ratio indicates a growing company. It's a growth company, a company where the analysts expect that at some point this $1.40 that each share of stock is earning is actually going to be worth $28.30. Otherwise, it shouldn't be selling for this price. And that's kind of the gist of what we're dealing with the PE ratio. That's it for this financial statements analysis chapter. You will also have a comprehensive problem that's going to be that is going to be out there related in large part to what's going on with this financial statements analysis chapter. Have a good one.